To figure out what's going on. This market's a little bit crazy. Now, I understand. Well, let me turn my camera on. Well, oh, there I am. Okay. So this market's a little bit crazy. There are a lot of reasons for that, and let me try to describe some of those reasons for you in the next few minutes. But I know a lot of you are involved in various investment competitions, including our sustainable investment competition, which, by the way, is fantastic, and you're all doing a great job. And some of you are involved in other investment competitions, and that's wonderful as well. And I want you to all do a fantastic job in all of your competitions. But listen, so the market's a little bit crazy. I don't want you to get at this point in time. At this point in time, I just want you to develop a long-term strategy that's going to be like viable for any market conditions, and then stick with that strategy, regardless of the short-term shocks we get going on in the market right now. Because let's face it, there's some crazy stuff going on that you can't control and you can't have any influence over. So it's one of those things where I know it's going to be troubling for you that, you know, for example, the Fed raises interest rates more than expected or less than expected, or some economic report comes out, blah, blah, blah. The best thing you can do, honestly, know your companies and understand the macroeconomic environment and how that's going to impact your companies. Are their earnings going to grow faster? Are their sales going to grow faster or not? Or are they going to decline? Because I've had a lot of conversations with people recently where there are a lot of assumptions that certain companies that grew a lot in 2000 and 2001 are going to be growth companies again in the future. And that's not the case. So instead of just being, you know, watching the day-to-day market, you need to really drill down on your companies. So every one of you I know is in a team, and you're covering a certain sector, and you're covering a certain amount of companies. And what you really need to do is figure out, listen to the conference calls, read the press release, figure out, are those companies going to earn more money than last year or less money? Are earnings going to grow faster or slower? That is what's going to drive stocks up or down. And so that's the thing that's really important to pay attention to. All right, so I've got a couple slides here and a few videos. So let me flip over to those real quick, and then we'll get into some details about what's happened over the last couple of weeks. So I'm sorry I haven't seen you in a while, by the way. Interestingly enough, what happened is, so I guess partially because of our sustainable investment competition and how well it's going, we got invited to the COP27 conference in Sharm el-Sheikh, Egypt, which is the UN conference on sustainability. And I got to tell you, it was a wonderful experience. I couldn't believe how cool it was, to be honest. It was a great experience. Met a lot of people, and had a wonderful time and learned a lot. I learned a lot, and that's, I think, the important thing that they're trying to get across, is that everybody should learn something. Anyway, let me share my screen and let's talk about the market, and let's not talk about necessarily sustainability. I know you guys are all on top of that. The name of the game right now in terms of investing is earnings and the economic environment. I mean, they're both like at loggerheads with one another, because the economic environment is kind of sometimes good, sometimes bad, but bad news is good news. Maybe the Fed won't raise rates, maybe they'll pivot and they'll cut rates, and the market rallies, and then all of a sudden the earnings come out and they're trash. I mean, it's a really tough environment. Don't worry about it that much. Look, just develop a good long-term strategy, whether it's our investment competition or any other investment competition. Develop a long-term strategy that's going to work for 10, 5, 10, 15 years. Those are the time frames you need to be concerned with. You can't control the day to day, okay? So don't worry about that so much. All right, so let me share my screen a little bit. We'll talk about what's going on in the market, and we'll talk about what's going on in the world. So I'm just going to go ahead and click on share sound now because I know I have some videos coming up. So, all right, I'm just going to show you this slide every single time I talk to you guys because, you know, it's like every week I talk to somebody who's doing an investment competition strategy and they forget this. So I'm going to say it, and I'm going to say it again. It's like Winston Churchill. He said, all right, this is a quote. Say it once, say it twice, say it 3 times, and give it a good whack. All right, so I'm going to say this again. Pay attention. What makes stocks go up and down? Earnings. This is why stocks go up. If earnings go up, if dividends go up, if companies are repurchasing shares is a good thing. EPS is going up, that's a good thing. That is what gives stocks value. You are the owner of a company that has positive cash flow and earnings, and they pay you that cash flow, often in the form of dividends, but otherwise in the form of share repurchases or whatever. That is a key thing to remember. It's like owning a deli on your corner. You buy the deli, you make the sandwiches, you get the money. Same thing, okay? Get the money. Cryptocurrency is a completely different thing. We've seen that in incredible terms the past couple months. Since I've spoken with you last, FTX has declared bankruptcy. Other crypto exchanges have declared bankruptcy. Crypto is a neat technology. There are no earnings. There's no cash. It doesn't own real estate. Apparently, the people running the exchanges have stolen the crypto and loaned it out to other people. Look, stock is highly regulated. It's the ownership of a company that makes money. That is an investment. A lot of these other things are just speculation. So anyway, earnings. You know what? I should write that on the next time. Next time I do this slide for you, I'm going to put earnings 3 times. Earnings, and dividends, and share repurchases. All right, well, here's the other thing. Changes in growth rates. And I mention this again because a lot of people want to be investors in growth stocks, and they want to have growth strategies. So let me share with you for just a minute some conversations I've had with people over the last week or two. Some people have shared with me their strategy of being for example, a large cap growth strategy, or a small cap growth, or a tech growth strategy. And that's fine. That's like really a great long-term strategy. There's nothing wrong with that. And I'm not going to criticize that. Being a large cap growth strategy, great strategy. But so here's the thing I want to talk to you guys about right now about that. Changes in growth rates, very key. If you're going to be investing in a strategy, you have to follow that strategy. If you love a company, but suddenly the growth goes down or turns negative, then it's not a growth company. You have to sell it. And that's happening for a lot of tech companies right now. And I know a lot of people, they get fixated on what worked last year or 2 years ago, and they love companies like Tesla and NVIDIA and whatever, AMD. And for a lot of those companies, the growth is not accelerating. It's decelerating. Or for some of the ones I just mentioned, the growth is negative now at this point. So it's one of those things where if you want to be a long-term, have a long-term strategy of, for example, long-term growth or large cap growth, fine, that's great. But when the growth disappears and turns negative, you've got to sell those companies. You can't be fixated. You can't fall in love with your companies. Remember, for all of you who've taken my classes, you know this. I've talked to you about this. Don't fall in love with your stocks. I mean, you can like the companies, you can like the management team, you can like their strategy, but the stocks go up and down based on different things, sometimes based upon emotional aspects of what investors are doing in the market. And the value of the company is sometimes different than the price of the stock. And so, listen, sometimes you just have to be very, very cold hearted and sell the stock. Okay. Sometimes you just have to sell the stock. Don't be shy about it. Caillou asked a really good question. He's sent in a direct message. You could have sent this to everybody. He asked a really good question. How should future growth be factored into your decision to buy or sell? It's one of the most important decisions. All right, so there are a lot of factors that you should look at when you're buying or selling a stock. Growth is one of the most important ones. The other ones are the valuation. That would be like the most important one. So valuation would be number one in my book. Growth would be number two, because the alternative to stocks, let's say, for example, is bonds. Bonds are a fixed income instrument. Stocks should be a growing income instrument, right? So the yield may be a little bit lower now, but if earnings double, blah, blah, blah. The reality is that stocks should be able to grow with the economy, keep pace with inflation, do all of the things that stocks have traditionally done. So this is why it's really important right now, because a lot of people are fixated on the stocks that were growth companies yesterday, last year, 2 years ago, 2000, 2001. A lot of those companies are not growth companies anymore. They're negative growth companies. And we'll talk about a couple of those in detail in just a few minutes. But I want you guys to be aware that if you're gonna pick a good strategy like small cap growth, technology growth, large cap growth, all right, fine. But if the growth goes away from your companies, you got to sell those stocks and buy the other stocks that actually have growth. All right. So you've got to be nimble. Be nimble. Changes in growth rates are very important. It's probably one of the top considerations when buying stocks. All right. And of course, interest rates. And we've still got this problem. I've talked to you about this so many times, but the Fed is raising interest rates. That raises the interest rate on bonds. It's got to increase your discount rate for so many of these companies. If they want to grow their business, for example, they have to borrow money. If you're a real estate company, you're going to take out a mortgage and buy a new hotel or new apartment building or whatever it is. But if that interest rate goes up, the amount you can pay for that building goes lower. So maybe you can't make that purchase and you're not going to grow, and then the stock kind of deflates. I'm giving you a simplistic example. A worse example would be a lot of tech companies that have no earnings, and they either need to raise more equity or borrow money. And now that the price of capital, the cost of capital is going up, it's very expensive for companies to raise new money. And so companies that have no earnings are in big trouble, and those are the stocks that are performing the worst. So, all right, future expectations, that's another big thing. We've seen something recently. I'll give you an example. I'll show you a video clip about this in just a minute, where some tech companies are actually doing okay on their earnings because they've reduced the expectations so much. But then they've issued even lower guidance, and they continue to cut their guidance lower and lower. And when those future expectations go down, that goes directly to this, right? If you start chopping down your future estimates for your earnings, that means your growth is going down. The worst example this past week, was CrowdStrike. Great earnings report. They beat earnings. Revenue was good. Earnings were good. Future guidance, terrible. And the stock was down 25, 30%. It was a tough week for that. And so we've got this situation, and I know you guys are having a hard time navigating this, and it's hard for everybody. where you've got the situation where there's a balance between, well, is the Fed going to cut rates or what's going to happen? And earnings are going down at the same time. Fed might cut rates, market rallies. Earnings are going down, market crashes. Fed might cut rates, the market rallies. Earnings are going down, the market crashes. We're in this cycle. It's a continuous cycle of going lower. We're in a bear market. We get these bear market rallies. And if there's dollars talk out of the Fed, the market will rally harder. And if there are terrible earnings, the market will go down harder. It's pretty simple, actually. All right, so let's see what we got. Here's what happened over the past several weeks. This is just what I said. Let's make it quick. Look, here we go. Lower highs, lower lows. You know what? I know later tonight on Sunday, Mark Arbiter is probably going to do a technical analysis talk. You can get on the call with him. He's going to talk to you about lower highs and lower lows. You got lower highs and lower lows, and this is not a good sign for any stock. And this is the S&P 500 right here. So this is the broader market. Nothing to write home about here. Nothing's overbought. I mean, nothing's really overbought, but the reality is the Fed's going to have a meeting next week. If they raise by 75 basis points again, it's going to be one of these, and we're going to get right back into this trend, and we're going to end up somewhere down here. There's no question about it. Because the earnings are nothing to write home about. The earnings are terrible. Companies are earning less money. Their revenue's not growing. For a lot of these high-flying tech growth companies, their earnings are actually shrinking. So we've got a big problem here. So we gotta keep our eye on this. And this is just like a technical look, but look, it doesn't lie to you. So again, I'm going to show you this chart because every now and again we got to look at inflation. Inflation is important. There will always be inflation. The government promotes it because deflation is worse. But keep your eye on things that are getting better, not things that are getting worse. Food and beverage companies, that's good. Things that went from red to green, things like rents. I mean, that's not a huge number, but it's a huge recovery. So, rental companies doing good. Let's see, what do we have here? Oh my goodness, look at this one. I don't know if you guys have flown anywhere recently, but like I said, we went to the COP27. Every single plane I was on, I found like 6 planes in the last one. Packed, absolutely sold out. And their biggest cost is jet fuel, and the price of oil is going down. So airlines are able to name their price right now in terms of their airfares, and their costs, their expenses are going down. Huge time to invest in airlines. All right, so look, just pay attention to inflation, pay attention to the macroeconomic drivers for whatever sector you're covering, for your team, for your investment competition. Okay. Why do we have inflation? Yeah, we had this. So we printed a lot of money. This is the M1. It's the money supply in the United States. And well, it's pretty gross. Pretty much every dollar you've touched in the last year was printed within the last 2 years. We printed a lot of money. I know that we like to make excuses about inflation is because of the war, or this or that and the other. No, it's started before the war, and it's because of COVID. We printed a lot of money because we needed to keep everything solvent while we were in a lockdown. And so here's the important thing that I want you to note about. It's not that we printed so much money to cause inflation. We already know that. It's this part here at the end. You see that? It's going down. The Fed is shrinking its balance sheet. It's not just that the Fed is raising interest rates. The Fed is reducing its balance sheet. A lot of this money is money that they've created by not just printing money. Of course, they can't do that. Treasury can do that. But they've created money by buying bonds, buying treasuries, and buying mortgage securities, for example. But now they're just letting those maturities roll off. When those bonds mature, they just let them roll off their balance sheet. And what happens is that money gets sucked back out of the economy. It's getting reabsorbed. And so this is a really interesting thing that I think is going to have a really deleterious impact on the economy, perhaps more than inflation rates. Everybody's fixated on inflation rates, but I think that just sucking money out of the economy is going to have a big impact on what's going on. Okay, so here's a little table. This is from Fred, and this is the first time in pretty much forever that we've got negative money growth. So, you know what? Shame on me, because now that I think of it, I should have had a chart on this, but I should talk about the shape of the yield curve. And if any of you have taken classes with me before, you know I talk about this a lot. We've got time over here, and we've got interest rates over here. And usually what happens is, if you're just going to loan somebody money for a month or something, then the interest rate will be down here. Or a couple months, the interest rate will be here. A year, 3 years, 5 years, it's a little more risky. You don't know if they're going to repay you. 7 years, 10 years, 30 years. So this is the normal shape of the yield curve, where the longer you loan somebody money, the higher interest rate you have to charge, because you're taking a lot more risk. But what we have right now is something called an inverted yield curve, where the yield on 2-year treasuries is up here, and the yield on 10-year treasuries is down here. So we've got one of these things going. And that's really bad. And I'll tell you why, for several reasons. First, let me erase the first yield curve. I'll erase the normal one, and let me talk about the inverted one, which is what we have right now. So the inverted one, oops, the inverted one, we've got this spread right here, is bad for a variety of reasons. And one of the biggest ones that's easiest to explain is this. Let's say you are a bank, and you make money by making loans on cars for 5 years, or business loans for 10 years, or mortgages, which is usually a 30-year loan, right? But you borrow money at the short-term interest rate, what you pay on savings accounts, checking accounts, and I don't know, maybe 2, 3, 5-year certificates of deposit. So you can see the problem. If the interest rate on these short-term rates moves higher than the long-term rate, then the bank can't make any. And I know you're thinking to yourself, who cares, right? Who cares? It's just the bank. The problem is this. If the bank can't make money, they're not going to make any loans. And if the bank doesn't make any loans, nobody can buy a house. And if nobody can buy a house, that really shuts down the economy, because the housing sector is a huge part of the U.S. economy. When you think about it, it employs a lot of people, not only just the building of the house, but in factories and transportation industries throughout the country. So, it's a big issue. And an inverted yield curve like this, where the short-term rates are higher than the long-term rates, has predicted every single recession we've ever had. Sometimes, though, the yield curve has inverted and there has not been a recession. But I wouldn't bet against it, because it's got a pretty good track record of predicting recessions. Keep that in mind. All right. So the other day, a couple days ago, Amazon, well, Jeff Bezos, I'm going to equate him with Amazon. He came out and said, hey, you know what? Holiday sales were the greatest of all time. Well, let's face it. Inflation is so high that, and this is the problem. This is what inflation does. It reduces demand in the aggregate, and it doesn't show up in the economic numbers, because it looks like retail sales are high and rising. But the reality is, if you're paying twice as much for the same number of goods, you're buying half as many goods. And so that really impacts the economy, because what happens is, if you're buying half as many goods, the factory has to lay people off. And so that's kind of what we're seeing here, where we've got the nominal in white and the real in blue. And the real isn't adjusted for inflation. So we can see that we've got really good sales growth of 4.5%. But after you subtract inflation, we're at a negative number. So we are in recessionary territory in terms of retail sales. And what that means is, even though the economic numbers like retail sales are going to look great, people are buying less stuff. They're buying fewer items. That will lead to layoffs. That will lead to shutdowns, not just at factories, but then for truckers, trains, shipping companies. It could have a really bad impact on the economy. So we've got to be cognizant of this. So keep an eye on these things for your industry, whatever sector you're covering for your team. Keep an eye on these numbers. It's very important. Some of the financials are doing great, but it's not just FTX that's having a run on the bank. There are other big banks, central banks, that are having a run on the bank right now. And this is something that's worrisome. And the reason it's worrisome is that a lot of times, the last 2-3 times we've been in this situation, it's the same story. Things are under stress, but the economy's still growing. We're still adding jobs. It's not that bad. We might get through this. But if there's a financial crisis, that could be really bad. And we're starting to see some strains in the financial sector. It's not just FTX. I know you guys love your crypto and you know all about FTX and what happened there, but it's Credit Suisse too. Huge outflows from Credit Suisse. There's a run on the bank in Switzerland. If there's a run on the bank in Switzerland, there can be a run on the bank anywhere. Trust me, this is not a good sign. So, be cautious, be cautious. All right, so a lot of you I know are participating in our investment conference, which is focused on sustainability, and I love you for that. But a lot of you are focused on other investment competitions. So let's talk about what the professors at those institutions say.
So, Professor, I asked Roger Ferguson, former Fed Vice Chair, is Jay Powell really in charge, or is the 10-year in charge? And what I meant by that was, isn't it good that there is a governor, a real world market governor on the Fed? Because if the 10-year telegraphs you've done enough, the Fed's going to have to listen, or then they're just really stubborn. Do you think that's a positive?
Yeah, you have to listen to the 10-year. Listen, Joe. In less than in about 15 minutes, we're going to get some important housing data, the Case-Shiller data, the Federal Housing Loan Agency data on housing prices. I expect them to show an actual decrease in home prices, something that the Fed can't ignore, even though their lagged way of computing it. Now, they're going to get the CPI, it's often been mentioned, the day before the FOMC decision, and the CPI on housing is going to show a positive increase. So the 10-year looks at the real world, and they don't see the prices increasing. They see the prices decreasing. We're not even talking about a slowdown in housing inflation. We're actually talking about negative housing inflation, and we'll see. But I bet in 10 minutes we're going to get negative numbers there. This would be the third month, and they look at on-the-ground price indexes, and the Fed ultimately can't ignore, despite what they say and despite what they quote, those on-the-ground price indexes.
The Fed, I mean, are we all in on the sort of the game? Talk, they can talk, can't they? And that can lower inflationary expectations. They can do a lot of talking about where they're going to go and what the terminal rate is, and that's cheap. That doesn't cost them anything. It doesn't mean that they actually follow through on it. Is that part of what they're doing here? And will they look and listen to market conditions in terms of not stock market? It looks like they like it when the market goes down for the wealth effect if they're trying to hurt demand. But they would have to ignore the bond market at their own peril, and they could go too far. The bond market could be saying, stop, stop, and they could go too far and just bring on their own hard landing that wasn't necessary.
Yeah, absolutely. The Fed is really very data dependent. I mean, I've mentioned before that kind of laugh when they say all through next year, we're going to, keep the rate tight all the way through the end of 2023. Well, take a look at their past predictions of what they were going to do. A year ago, they were not going to raise the Fed funds rate more than 25 basis points this year. Well, what did they do? I do expect a 50 basis points because I think the price data is going to look good in the December meeting. I really hope that they really just pause after that and let the tightness that they've already induced and the decline in the money supply. By the way, we got it last Tuesday, the 7th consecutive month of decline in the money supply, the biggest 7-month decline since World War II. I mean, this is a very restrictive policy that if they...
So what he just said right there goes right back to the chart that I just pulled up from the Fed, and it's a really restrictive monetary policy, very restrictive monetary policy. Anybody who's like trying to invest in a growth strategy right now, you've got to be very cautious.
Try to keep this restriction going through next year. A recession is virtually 100%. But I think they're going to pivot once they see the weakness in the data come through.
All right. So he kind of caves at the end and says they might pivot. But that doesn't matter. If earnings are still going down, stocks are not going to go up. And I've had a lot of conversations, a lot of you, about strategies and how to develop them. And the reality is you can't base your strategy on the Fed is going to pivot. You don't know if they're going to pivot. You don't know when they're going to pivot. They might not pivot. They might crash the economy. In fact, it's increasingly likely. They might not crash the economy. I don't know, but earnings are still going lower for a lot of former growth companies. So, whatever your strategy is, you got to adhere to it. If your strategy is growth, well, it's not going to be tech companies right now. It's going to be something else, right? It's going to be consumer staples or energy companies, right? That's just the way it is. Those are the companies that have growing revenue and growing earnings. And I know you probably don't want to hear that. And you think that everything in tech is going to grow again as soon as the Fed pivots, but you don't know if they're going to pivot. And you don't know when they're going to pivot. They might raise interest rates a lot. And even if they do pivot, you don't know if earnings are going to start going back up for these tech companies. They had tailwinds, an unusual boost in revenue and earnings because of COVID lockdowns, where everybody had to work from home and go to school from home. Everybody had to buy a new laptop. Everybody had to update their software with Apple or Microsoft or whoever it was, Adobe. And that's not happening anymore. We've all got new laptops and we've got updated software. Just don't need to do that again right now. And typically this has been a really cyclical business anyway, and it usually improves when earnings increase and companies hire more people, because typically people go to an office and then companies buy a lot more desktop computers and software and networking hardware and stuff like that. But right now we've got a situation that's kind of an unexplored territory where people are only going to the office 1, 2, 3, 4 max days a week. Nobody's going to the office 5 days a week anymore. So a lot of companies just don't have to buy new tech software or hardware. And so that whole cyclicality is disrupted right now. So be cautious on tech, be cautious on software. It's a real tough time to predict what's going on there. Okay, so what's going on next week? All right, we got some big numbers coming out, and I want you to focus on a couple of things. So Jerome Powell was out this week and said some stuff that was kind of dovish. He said maybe we could taper our interest rate increases as soon as December. We're going to find out this week. Okay, right here on Wednesday, there's the Fed interest rate decision. Now, the forecast now is for a 50 basis point increase. And previously, they had increased interest rates by 75 basis points, time and time again. So we'll see what happens. Now, if Jerome Powell is true to his word, maybe they'll increase by only 50 basis points. If they increase by 75, though, you better expect the market is going to do one of these. It's going to take a header and it's going to get crushed. Even if it goes up by only 50 basis points, it's not a great deal because everybody expects it already. Nothing is going to be good for the stock market unless they pivot and stop increasing interest rates or cut interest rates. And they're not going to do that. They're just not. They're way behind the ball when it comes to inflation. They're only at 4.5%. And inflation is, let's go back up here. Look at these inflation numbers. Look at how high these are. All right, so they've got a lot of runway to raise interest rates before they get to even. All right. So here's where we are with the S&P 500 and for your stocks. We've got these stupid bear market rallies time and time again, where everybody's like ignoring that earnings are crashing. And they're like, hey, the Fed will cut rates, yay. And then they don't. And then they raise rates, and then the market crashes again. And the reality is this. I'll go back to slide 2. I'll back up all the way to slide 2 if you want me to. The only thing that makes stocks valuable, earnings. They earn money. Okay, so this is the important part. Do not be this guy. Don't be Drake. Don't be Drake, okay? Don't ignore the earnings. Actually, you know what? I shouldn't diss Drake because Drake makes a lot of money. He's actually this guy. He's this guy right here. Earnings. He makes so much money, and that's what counts. So if your companies are earning more money, then maybe that's a good stock. Look at the valuation, and maybe it's a stock in which you can invest. Keep that in mind always. Don't be somebody investing in stocks that had higher earnings in 2020 or 21, because some of these companies are earning a lot less money now. In fact, their revenues are going down, their earnings are going down. Just because the stock is down 50% doesn't mean it's going to bounce back. If the earnings are down and crashing, if the earnings are crashing, the stock is going down and it's not coming back anytime soon.
Weak guidance from NVIDIA sending shares of the chipmaker tanking. Could that be the news to take air out of the market tomorrow? Will this reignite those fears about technology, the fears about a change in the environment, a change in terms of how we should value these companies, Dan?
Yeah, let's be very clear. That guidance was not particularly bad, and they used the sort of mulligan that you might have expected, right? Supply chain issues as it relates to Russia, and then the continued COVID lockdowns in China. So I think we all could have expected that. If you look at the guidance that they gave, it's not really that bad for Q2. I think the issue why this stock is probably down in the aftermarket, that investors in this environment have been conditioned to shoot first and ask questions later, and that's probably what's going on. I think at its lows in the aftermarket was down 10%. Again, this is not a whole heck of a lot of volume, so it's not really indicative of that. But, you know, here's a stock that's been cut in half. It trades well above a market multiple. It trades about 12 times sales. And if those sales were set to decline, let's say greater than what the company just guided to.
I want you to just pay attention to what that guy just said. Let me turn my camera back on. The stock trades at 12 times sales. Uninvestable. Uninvestable. If it's not a growth company, and it's not, because growth is going down, it's a negative growth company with negative revenue and negative growth. Well, negative revenue growth, it's negative. All right. Anyway, you get my point. It's not a 12 times sales company. Are you kidding me? The valuation, the earnings, two important factors. And then layer into that what we talked about earlier, the growth rate. If growth goes negative, then you can't pay a premium multiple for sales or earnings. You just can't. You can't pay 12 times revenue for a company like this. Don't be crazy.
You would see this thing probably making new 52-week lows and be re-rated like almost every other great growth stock in this market.
Yeah, already cut in half. I think that's key, Tim Seymour. What we've seen is, a stock can come out like this. It's already been cut in half. It's already been beaten down. And yet it still manages to drag the entire sector lower. We saw it with Snap. Snap, a much smaller company than NVIDIA. And that took Apple down the next day.
Yeah, I like those data center revenues. It actually, I think, is a pretty good read on some of the broader players in the space. But obviously, we also saw that these numbers have taken down AMD, Micron, Marvell, and so they're trading as a group. I do think that the outlook here is decent. I think, let's wait and hear some more. I think the gaming revenue is of a concern. The multiple isn't terrible. It's obviously great relative to itself. It's somewhere around 20 times forward. What we forget here is that this was a stock that was from February of 2020 to even where it traded up to. It's pulled back 51%, but it moved 500%. Essentially in 2 years, 2.5 years. It's a dynamic here where I think, people have to understand what to pay for these stocks at this point. There was nothing bad, I think, relative to the environment we're in and what these guys said about China and Russia, as Dan pointed out. Like, I don't think these are reasons you go out and sell this company. I do think it is a case where we still need to wait and see what the multiple should trade for.
I don't think this will be a snap moment for a couple of reasons. One, it was up going into this print, so if you take that out, it really hasn't moved that much. But what was so amazing about Snap was how quickly the business deteriorated from April 21st until May 21st-ish, give or take. And so NVIDIA, we haven't heard from them since a couple of months. So this isn't a huge move off of where they were. I think it comes back to the point Tim and Dan are making about what's the right multiple. Used to be these kind of companies traded at peak and trough multiples. This one's been at a sky-high multiple for quite some time, but it's not a lot to hate, I think, in this earnings release.
So it's all a matter of what do we pay for these sorts of companies, Guy? You had an interesting tweet. I think it was, I want to say it was a couple days ago, about Tesla. Tesla reporting a great quarter, and what has the stock done since then? Just gone lower.
Yeah. Traded up to 1080 that day in the after hours. I know Dan talked about it a lot. He got a lot of ats on the Twitter, and it subsequently traded down to $600. I mean, you can do the math. That's a pretty significant move. I'm looking at NVIDIA here, though, and I'm sort of scratching my head. I know it was up $8 or $9 during the day, so it's given that back a little bit more. But that second quarter guide, $8.1 billion. I think consensus was about $8.4 billion. I thought this quarter was okay. Again, I find myself surprised at the reaction in the stock in the after hours. I would submit you could buy the stock here, but the market's doing strange things. I don't think it was that bad as to have this move. The move to me is not commensurate with the guide, just my opinion.
Let's get some more details on the quarter. The conference call, by the way, is also just underway. Christina Partsinevelos is following the story. Christina.
Yeah, so NVIDIA's revenue beat was driven largely by record revenue in data center and gaming. So data center business sells chips for cloud computing companies and enterprises. And that section actually, or sector, just grew 83%, surpassing its core gaming business, which sells graphic cards for games as well as crypto mining. NVIDIA's auto business, though, that was down about 10% on a year-over-year basis. And despite this overall strength that we're talking about in categories, minus autos maybe for now, the company does remain cautious. You guys have talked about it. Guidance coming in lighter at $8.1 billion, including a $500 million hit relating to Russia and China COVID lockdowns. Keep in mind, though, forward-looking, the chipmaker did confirmed just this past Sunday it would slow the pace of hiring, joining other major tech firms that have decided to be more cautious with their operating budgets in recent weeks. Since you're seeing shares down now almost 7%, I will get on that call and hopefully get some more info as to why we're seeing such this massive drop, despite guidance coming in weak, but not as bad as maybe justified by this drop.
All right, Christina, thanks. But keep us posted. Christina Partsinevelos. Tim, what would you want to hear on the conference call?
All right. Let's just pause it there because I think we've heard everything we needed to hear. A lot of these high-flying growth companies, tech companies, have really stumbled recently, and it's not necessarily that these companies are even losing money. It's that the growth expectations have gone away. And that is causing a huge deflation in their stock price. You can't pay a huge premium.
Well, I want to hear some of the strength on the enterprise side.
And so, I mean, you see what happened. This is what we've seen recently. It's not a pretty picture. Now, so don't be someone who is professing to have, and this is going to be for our company investment competition or for any other investment competition. Don't be someone who's professing to have a growth strategy, a tech growth strategy, a large cap growth strategy, or something like that, and then still advocate to buy companies like this. They are not growth companies. Their revenue is going down. Okay, their earnings are going down. This is not growth. This is the opposite of that. Just keep that in mind. Okay. Yeah. So we've got, but we still have the bear market rally because, hey, if it gets bad, if bad news is bad enough, then that's good news. The Fed will pivot and they'll start cutting rates and then everything will go back up. No, you don't know that that's going to happen. You don't know when that's going to happen. You don't know if that's going to happen. And you don't know to what extent that might happen. Let's look at a more recent example. Here's another one. This is CrowdStrike. This is a really bad one.
Workday was extraordinarily good with an amazing outlook and a buyback. And Neil Bushry doing the famous pivot that you have to have. That's what I think they want to do at DoorDash. Intuit was an admit that perhaps Credit Karma is losing its karma. And yes,
they talked about degrading fundamentals across verticals.
Yeah, I mean that was just a tough one, not good, and that could be further cuts from Intuit going forward. And CrowdStrike was just plain out disappointing. Although George Kurtz did say, look, the big deals are okay. It's a small to medium-sized business. But you got, as soon as you see elongated cycles, macro headwinds, when you start seeing that C-suite takes longer.
CrowdStrike's a disaster, man. The stock's losing a fifth of its value.
I'm a diplomat.
It was really the revisiting annual revenue expectations that hurt him for 2023.
David's right. It was disappointing. It was disappointing. It was bad. Okay, what I'm saying
but they're citing of the macroeconomic environment as being seen as, well, could you say almost a positive by some who, again, ascribe to your view.
Had good economic environment. How is it possible that Palo Alto had an excellent economic environment and CrowdStrike didn't? You know?
So are you calling out CrowdStrike for not being completely honest here about what was the reason for the shortfall?
More specific, because George Kurtz is an incredibly honest guy. What he's saying is not to worry, but we have this, and I think therefore another guide down is probably in the cards, even though he didn't guide down.
Morgan Stanley's still on board. They say buy the dip. If you want to call that a dip, I call that more of a
buy the Marianas
crash.
Trench. Go down there with your gear.
Buy on weakness.
3/5 of the world is covered by water.
Estimates now appropriately de-risked from macro and positioning.
Untrue. That's just untrue. Because when he guides down the...
All right, don't fall in love with your stocks, okay? I know a lot of you love your stocks and you've been starting to cover them now, but don't fall in love with them. You can fall in love with the company. You can fall in love with the management. You can fall in love with their assets and their products, but don't fall in love with their stock. It's a different thing. Now, what happens, and if you've taken classes with me, you've heard me say this before, there are two different sides to the story. There's the sell side and there's the buy side. So what happens is when you look at people on TV, those are the sell side analysts. And what happens is they are the ones from the investment banks that want to underwrite new bonds, new stock issuance, IPOs, secondary offerings, things like that. They want to be able to sell the stock to you, the retail investor, and also to institutional investors like pension funds and mutual funds and ETFs and all of those things. So whenever they get on TV, they're always gonna say positive things about the stock and the company. They're gonna say it's great and everything's fine, even though revenue's going down and earnings are crashing. The cut their dividend and the company's about to file Chapter 11, you should still buy the stock. That's what they're going to tell you. The other side of the story is not the sell side, it's the buy side. That's the people from the pension funds, mutual funds, ETFs, things like that. And generally what happens is they don't go on TV and talk a whole lot unless they've already built a huge position. Sometimes you will see portfolio managers from hedge funds or mutual funds go on TV and they will tell you why they love a stock so much. The reason they tell you that is because they already own it and they want you to buy it so the price goes up so they can sell it. So just be cautious when you hear things like this on TV, okay? But pay attention to the macro environment and the earnings and the trend. The rate of growth, the trend, very important. But ultimately, the earnings are the most important things.
In the next quarter,
so let's wrap this up. Yeah, I mean, it was a bad day, but look, let's face it, CrowdStrike is like other tech companies. It's been in a downtrend, and there's no reason for it to bounce back. But still, hey, maybe the Fed will cut rates, so there could be a bear market rally. And you know what? We keep getting these stupid bear market rallies. We keep getting them, but they keep getting lower and lower and lower. Lower highs and lower lows. And I bet, and I may not be right, but I bet we're gonna be down here soon. We'll probably have a new low because the earnings are just not there. And the Fed is just not going to stop raising interest rates. And I know everybody wants them to, but they're just not going to stop. They're going to keep raising interest rates and earnings are going to go lower and the economy will probably go into a recession. Anyway, so because I was in Egypt, let's listen to one of our smartest Egyptian economists in the history of the world, Mohammed El-Arian, who, by the way, great guy, former co-CEO of PIMCO, Pacific Investment Management Company. Now I think he's like a professor at Oxford. Really brilliant guy. Let's listen to what he has to say.
You said this Fed is contributing to market volatility. What is it that Chairman Powell did on Wednesday that you disagree with?
So I said it contributed to undue market volatility. Is the undue part, excessive market volatility. Look, I think once again, the Fed did not understand the technicals. Once again, the Fed didn't understand the behavioral aspects of markets. So while Chair Powell went out of his way to be balanced, he did a few things that made the market hear just what it wanted to hear. First, confirm that we are downshifting in December. Second, do this ahead of the labor report, suggesting that maybe he knew something that others did not know. Third, talk about risks being now balanced, two-sided, and bring in his colleagues on the Fed. And then what he didn't mention, John, he did not push back in any way against what already was a significant rally in markets and a significant loosening of financial conditions. So while he said other things, and he was right to say other things, including warning about inflation staying, warning about our job not being done. He didn't realize where the technicals of this marketplace were, and he didn't realize the behavioral aspects. And that's why you got this overreaction, and now we're giving some of it back.
So, Mohammed, the equity market is basically back to where it was at the end of August when we heard from Chairman Powell at Jackson Hole. You talked about...
Okay, so let's wrap this up. So I don't want to keep you guys too long. I just want to give you an update on where the market is. And I don't want to scare you too much because, listen, I know this is an investment competition and you have to get invested. And I don't want to scare you too much. I do want you to be cautious. I want you to be a little more conservative in this market environment and maybe put a higher allocation to things like, I don't know, utilities, consumer staples, things like that, healthcare. And not go all in on a growth strategy where there's no growth, because a lot of people I've talked to, like, hey, I
that easing of financial
growth, and then they talk about a company that has no growth, like Nvidia or in this case, CrowdStrike. All right. So when your revenue goes down, you're not a growth company anymore. You're not a growth company. All right. So having said all of that, let me go back.
You said this Fed.
Let me go back to this slide. All right. Earnings are crashing. Don't pay attention. Federal cut rates. Yeah. We're going to get another rally. But that doesn't matter, because right now what we have is the Santa Claus rally. So let me wrap it up with this. So at this time of the year, every year, it's just like the 4th of July. Same thing happens in the middle of July, early August. This time of the year, all the traders, all the portfolio managers, all the analysts, they go on vacation. Trading volumes are really low. Nothing really happens. And the market just sort of gravitates, generally speaking, gravitates higher. Not always, but there's really not much chance the market's going to explode right now. So even though I told you a lot of negative things, be cautious and all that, the reality is this time of the year, the market just generally doesn't do a whole heck of a lot. Okay, you're in the home stretch. If you're in some of these investment competitions, your last trading date was a day or so ago on Friday, I think. Maybe next week you have to have your final report in. Finalize your long-term investment strategy. Don't get freaked out because the market isn't going to do much from here on in. So relax, have a good holiday season, everybody. Write a good report, write a good investment strategy, make it meaningful. You'll be fine. Everything will be fine. It's not a good market, I know, but it's not going to be terrible right now. So between now and the time the judges are looking at your strategy, probably nothing bad is going to happen because the Santa Claus rally is here. All right. Oh, also, I wanted to share with you this last slide, which is that everybody should be a long-term investor. And what I mean by that is this. Here's the stock chart of owning stocks just overnight, where you buy them at the close and sell them at the open. And that's versus a chart of your day trading. Now, anybody who says they're making money day trading is a liar. That doesn't work at all. The money is made, and I'll tell you why. Because stocks, companies report earnings after the close or before the open. All the macroeconomic reports come out after the close or before the open. Well, not all of them, but most of them. But earnings always come out after the close before the open. And so generally companies like to under promise and then over deliver. And even when it's a bad economy and they have to cut their guidance, the reality is they will cut their guidance to the point where they will beat their guidance and there'll be a positive upside surprise, and the stock will rally on the day they report their earnings. So that is the reason why you should be a long-term investor, even though there's volatility here. Look at this. Compared to being the guy or girl, whatever the case may be, something in between, who buys stocks in the middle of the day and sells them and has no holdings at the end of the day. This is not going to make you money because all of the action happens after the close, when all the economic reports come out and all the earnings reports come out. And those are the important things, earnings and whatnot. All right, so that's it. I don't want to keep you guys too late. Keep doing what you're doing. A lot of you have been in contact with me. I really appreciate it. You're all doing a great job on our competition, on the other competitions. So yeah, so Annie, so for our competition, Lynn, you can answer that question. For the other competitions, the last trading day was Friday. Is there a replay? Yes, there'll be a replay. We're recording this session. You can listen back to this. So no problem. Any other questions? I'll be happy to answer them if you guys want to stick around. Otherwise, I'm going to stop sharing my screen. I'm going to call it a night. I'm going to go back to watching football. Everybody have a great time. And I want to see some good reports out of you guys for our competition and for the others as well, okay? So if you guys have any questions about any of these competitions, economic competitions, or finance competitions, just let us know. We'll be glad to help you, okay? Okay, then, bye-bye, everybody. If there are no questions, I'll talk to you later. Thank you, Annie. Thank you, Chris. Bye-bye. Talk to you later.